By late 2025, NVIDIA reached a market valuation of $5 trillion. That figure is higher than the gross domestic product of every single country on Earth, with the exceptions of only the United States and China. That wealth is highly concentrated. Over the course of the year, AI-related enterprises accounted for roughly 80% of all gains across the entire American stock market. But research from the National Bureau of Economic Research found that 90% of firms reported artificial intelligence has had absolutely zero impact on their workplace productivity. To maintain high growth expectations despite that lack of utility, tech giants are building massive infrastructure networks. OpenAI alone committed to spending $1.4 trillion over 8 years to construct new data centers. This chart compares that spending to what the company actually brings in. OpenAI's $13 billion in revenue is completely dwarfed by their $1.4 trillion infrastructure commitment. The gap between those two numbers leaves us with a binary choice. We are either funding the arrival of a permanent global utility, or we are currently inflating the most expensive, mathematically impossible bubble ever built. Artificial intelligence carries a massive recurring physical cost, called inference, the compute power and electricity required every time a user types a prompt and hits send. Those costs add up quickly. Financial managers estimate that OpenAI burns through $15 million a day just to run its video generation software, Sora. This graph charts the law of diminishing returns in AI development. The curve showing model improvement flattens over time, while the curve tracking energy and financial costs steepens. It costs 5 times the energy and money to make a model only twice as good. Zooming out reveals a steep deficit. By 2028, OpenAI expects to report an operating loss of $74 billion. The industry is covering these deficits through heavy borrowing. Analysts at Morgan Stanley estimate that the debt used to fund data centers will exceed $1 trillion by 2028. Much of the debt holding this infrastructure together is low-grade. A significant portion of these data center bonds are currently rated as BBB, or junk status. The physical reality of running artificial intelligence requires massive server farms and power grids. That physical toll has created a debt engine that current software revenues cannot mathematically solve. To maintain the appearance of profitability, leading AI firms use a strategy known as vendor financing, or circular investment. This flowchart maps the mechanism. It begins with NVIDIA injecting billions of dollars of investment capital into AI companies and cloud providers like CoreWeave and OpenAI. Those companies then take that investment money and use it to purchase NVIDIA's graphics processing units. As the loop spins, this closed circuit of capital inflates NVIDIA's revenue on paper, temporarily masking the underlying cash flow problems of the entire ecosystem. Major financial institutions push back against the idea that this structure is precarious. Analysts at JP Morgan and Goldman Sachs point to real earnings growth, arguing that AI does not meet the classic criteria for a financial bubble. Federal Reserve Chair Jerome Powell has argued that unlike the startups of the late 90s dot-com boom, today's tech market leaders generate substantial enterprise revenue and sit on massive capital reserves. While those cash reserves are real, a systemic reliance on moving the same money in a circle masks a deeply fragile foundation. This relentless expansion reflects a market condition known as the rot economy. It's a system where businesses are rewarded for prioritizing growth at all costs based on future hypotheticals, rather than demonstrating present financial stability. Look at this breakdown of the S&P 500 index. Just 5 massive tech companies control this 30% wedge, representing the greatest market concentration in half a century. That concentration has global watchdogs sounding the alarm. Both the Bank of England and the International Monetary Fund have issued warnings regarding the specific overvaluations of leading AI firms. This historical stock chart visualizes the sudden decline of a market crash, which is exactly what these institutions fear. If the AI math fails, a market correction threatens to trigger a broader global recession and weaken the economies of developing countries. The tech industry has built the most advanced technology in human history, but it has completely failed to build a business roadmap to pay for it. Whether this market pops or deflates, the window for infinite spending has shut. Eventually, the math has to make sense.